Now, I promise I am not a fanboy necessarily of this Odd Lots podcast. And again, it's not nearly as good as Cup of Joe, so don't spend too much time there. But if you're going to listen to two podcasts within the Odd Lots basket, if you will, the last two that they have on there, they did one, it was either yesterday or 2 days ago, with the head of metals at Goldman Sachs. His name's Nick Snowden. And now the headline's a little hyperbolic. It says, why copper may be one of the tightest markets the world has ever seen. And you might be trying to grab some headlines there with that one. But I think it's an interesting one and an interesting structural issue that I think we should talk through, which is the overarching basically summary of what they talked about was the fact that unlike some things like growing corn or producing crude oil from shale, which, as I understand, it can take 3 to 6 months to bring shale production online. Things like copper, things like nickel mining, those are much longer duration projects to get them from, hey, I want more copper, to, hey, we're actually putting copper out into the world. I actually compared this to my analyst to making bourbon. I don't know how many of our viewers on the call know much about distilleries, but when you start a distillery, oftentimes they don't start with bourbon. And one of the main reasons why they don't start with bourbon is because by nature of how you make bourbon, it's got to be aged for a number of years in an oak barrel. So who's going to plop down all that money to build a new distillery and just sit there for the next 5 years while their bourbon sits in barrels and they can't make any revenues? Somebody might do it if they have a ton of cash. But oftentimes what distilleries do is to close that gap, they'll actually start producing shorter lead time distillates. Distillates make it sound like it's a crude oil product, but spirits. So vodka, tequila, gin, things that they can push out the door on a much quicker basis. All the while, the bourbon is sitting behind the scenes, aging, getting ready to be put into the market. That's kind of what's going on, or at least that's what Goldman is proposing is going on within the copper world, where for the next year, 2 years, let's say, it looks like investment in new copper facilities is actually ticking along pretty well with demand. And you can see that in the chart down below. That's going by year. It's basically showing the relative trends of supply with demand. And as we should all know, we would want those two things to be coordinated. You want supply to be in line with demand, or in a better scenario for all of our customers, you would want supply to actually outpace demand, because then you could bring down prices. You'd have more than what you need. Now, what they're depicting is a scenario whereby, unfortunately, it sounds like there hasn't been a lot of new investment, or there aren't plans of new investment going into 2026 and beyond for copper. So this is pretty long lead time type stuff. But if we believe their demand forecast, and if we believe that new copper mines aren't being invested in right now, you get kind of this alligator mouth where demand growth over the forecasted next 7 to 8 years is expected to grow and grow and grow, and we don't have supply to meet that. So that creates a real constraint. And I will caveat this by saying, anytime I see a demand chart that looks like this and just kind of straight lines it out in the future, I oftentimes question it and say, no demand curve ever works out quite like that. But we have to make some assumptions here. And if we assume that electric vehicle growth is going to continue, if we assume that the ESG trend of electrification, wind energy, hydropower continues, the argument here is that from a demand side of the equation, you've got this whole new market that's going to require a lot more investment into the electric grid. You can't really get electrification without more investment in the electric grid. And with that investment, you're going to get more demand for copper. And if we don't have investment taking place, coming back to that bourbon analogy, if we don't have that investment in copper taking place 5 years before it's being demanded, you're going to wind up in constrained scenarios. And what happens in constrained scenarios is prices can go to the moon. You basically get a short squeeze. And now, again, I do kind of want to caveat this whole projection with, if we end up seeing copper go from $4.50 to, they actually mention in the podcast, $25, $50 per pound. If copper goes to $50 per pound, I'm going to guess you're going to have demand destruction. People are going to find alternative sources of electrification. People are going to stop pushing for electrification. Somewhere in here, you're going to have kind of a broken market if this is how it plays out, because copper going to $100,000 per metric ton does not bode well for the green electrification future. So something here I think is probably going to change, but as we sit here right now, it is a pretty interesting dynamic and a pretty interesting proposition for maybe the 3 to 5 year, 7 year horizon for where copper prices could go. In the short term, again, it's looking like we're fairly well supplied. So this is a pretty long-term forecast, but I thought all of you would find that pretty interesting. If you dive into the podcast itself, he goes into much more detail than what I just did, but that's the general idea here. So it could get a lot of these themes we're seeing. I mean, 2 years ago it was steel. We didn't have enough steel and demand was coming on at a faster clip. Now we're seeing it happen in energy in a big way. This is the proposal that if it happened in copper over the next 5 years as we try and electrify our world, it just seems like a big whack-a-mole for commodities and manufactured goods is taking place across the board. So there are a lot of things we got to be discussing and hopefully investing in soon before they become bigger and bigger issues. On the pricing side of things, again, Nick Webb loves charts. There's a technical pattern that some technical analysts reference, which is called a bull flag. And the idea behind a bull flag is that you basically got a flagpole, and you can kind of see that in this 2020 into early 2021, the big sharp move higher, and then a large amount of consolidation. And when I've kind of highlighted it to make it look a little like a flag, but you can see that it sort of does look like a giant flag waving in the wind. This is generally, at least in a technical analysis standpoint, viewed as a fairly bullish chart pattern, because it's the idea that you've had a big run up for some reason. The market's kind of cooling off a little bit, trying to digest and consolidate, take a breather, and then perhaps the trend continues at some point after you've gotten the weak hands out of the market. I don't know for sure if that's how it's going to play out, and certainly we tested this fairly closely back in, let's call it March, April, when China shut down. We came down to the low end of this flag, if you will. Very quickly in the last couple days and weeks, as you can see, copper prices have recently jolted back up above the 50, 100-day, and 200-day moving averages. So I think a lot of that is probably coming from the expectation that China is going to come back online. They're going to rejuvenate the demand for copper. And at least from a technical and momentum standpoint, it's kind of back in gear at this stage. So we'll see how it plays out. I mean, obviously, we've got some headwinds coming from Europe. I think we've got some headwinds coming from North America at the moment. But as some economists like to say, copper's got a PhD in economics. And right now, that PhD is saying things are looking a little better than they were a few weeks ago.